In the 2020 book, The Psychology of Money, author Morgan Housel succinctly highlights that compounding doesn't rely on earning big returns. Merely good returns, sustained uninterrupted for the longest period of time, especially in times of chaos and havoc, will always win. There has certainly been a significant amount of change and uncertainty this year, and several periods which I know many would describe as chaotic. Equity markets, in the large part, have digested events surprisingly well so far, albeit with volatility along the way, and not ignoring some notable changes in regional market leadership and currency movements. However, economic stresses and strains do still lurk, and Housel's quote, in my opinion, has read across to the assessment of corporate quality in the context of investment. Quality is clearly subjective, but the asset manager Fundsmith is well known for its strict and focused implementation of the quality factor, aiming to only own stocks which meet their criteria of being able to sustainably compound a high return on capital employed in cash over the long term, and do so through resilient business models which do not require the need for high levels of leverage. In this week's episode, we were delighted to be joined by Head of Research at Fundsmith, Julian Robins, for an update. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were delighted to be joined by Head of Research at Fundsmith, Julian Robins. Julian has extensive investment experience, having started his career in stockbroking back in 1984. He joined the investment banking arm BZW in 1987 and held various roles, including as a senior bank analyst, and this is where he first worked with Terry Smith. After leaving BZW, Julian went on to Colin Stewart, again alongside Terry, and after a successful decade at the firm, Julian was one of the co-founders of the asset manager Fundsmith in 2010, and has been instrumental in managing the company's flagship equity fund since launch. We interviewed Terry Smith in one of the very early episodes of the Investor Insights series back in Q1 last year, and the discussion points in this episode, number 3 in the series, remain just as highly relevant today in my opinion. However, much has happened over the last 18 months, and so we were delighted to grab some time with Julian ahead of a research trip across Europe to discuss some more topical subjects. We hope you enjoy the episode, and as always, please do get in contact using the series email address investorinsights@killik.com should you want any further information on any of the topics discussed. Julian, good afternoon. Over from the States, and very pleased to have you in person in the office to record this. So thank you so much for sparing your time. How are you doing today?
I'm good. So I come over to London pretty much every month, and I always take pretty much the same flight on Sunday evening, lands first thing this morning. So I'm always one of the first people in the office on Monday morning, and I'm always hoping that my brain is in gear after the overnight flight. But we'll see.
Yeah, we'll see how we go. Yeah, thank you again. So we've got this standard opening question that we ask kind of everyone on the series actually, and all it really aims to do is kind of get to know you a bit better, kind of how you go about your work really. And what we ask is kind of an anecdote from a recent meeting or a trip you've been on maybe, or just a research project, or even just a book or article. Is there anything you can kind of share just to give us a bit of an insight into you?
Yeah, I mean, I think I could share something on all of those. I just started reading. I mean, I should have read this, long ago, but I just started reading Marcus Aurelius's Meditations. Struck me that being stoic was quite a good thing to be at the moment. We've had some interesting company meetings recently. I mean, I guess one of the nice things about this job is that you do get to talk with people who are running some of the biggest companies in the world. And back in the middle of February, we had a meeting with the then CFO of Unilever. And when Unilever made their changes a couple of years back, we were pretty enamored with the new CEO, but we were extraordinarily enamored in a good way with the new CFO, who's been described since what I'm about to tell you about happened as a human tornado. And the last thing I said to him was, please don't go off and be chief executive of Procter & Gamble. And the following week, he was appointed as the new chief executive of Unilever. The other sort of bookend is that back at the start of the weight loss craze, I had asked the then chief executive of Novo Nordisk whether it was ever possible that these weight loss drugs would be over the counter. And he said to me, well, we don't want to make these some sort of lifestyle drugs. And I said, I think I did say, well, why not? And unfortunately, he has just been let go by Novo Nordisk, I think because he didn't capitalize or hasn't capitalized sufficiently on a lot of people's aspirations in that direction. So I guess, as I said, one great part of the job is getting to meet these people who are, extremely important.
Yeah, no, thank you for that. So you might come on to talk about some of the kind of things you look at in terms of leadership in a later question, and when that changes. So that's a good segue into that. And one of the, I guess, primary developments, I'm not sure when our last meeting was, but since that time is that change in US trade policy. That's one of at least one of the big kind of news stories impacting financial markets. I wondered, I know it's a big topic which is ever changing kind of week to week, but I wondered if you could kind of summarize how you've approached assessing the impact across the Fundsmith portfolio, and how you kind of foresee companies responding to kind of increasing tariffs.
Yeah. So I guess one of the rules we have at Fundsmith, one of the informal rules, is that we try not to spend too much time working on something when we are doubtful that we are going to do anything with the output. So it was, for example, possible when the first round of new tariffs were announced. It was possible with, say, a company like Nike that gives you very detailed information on where its sneakers and its apparel is manufactured. It was very easy to say, well, the input costs, because of tariffs, are going to go up by X, and so Nike's going to have to put its prices up by Y, and that ain't going to happen. And so it was possible to sit there and think, well, sort of what should we do? But other than that, we also have a thing at Fundsmith where we try to imagine that or we think about companies that have been successful, and we try to think about what has made them successful over the past 50 or in many cases over 100 years. And generally it has things to do with they make great products, they offer great value. And we say to ourselves, in how many of those cases have things like tariffs or interest rates, or, since it's quite topical, even World War, been the reason why they've been successful? And I suppose the last thing is that if you invest in fairly large companies, one of the reasons why they are probably quite large is because they do a lot of trade internationally. And over the last, however many years you can mention, investing in companies that do have large sales in China or India or Asia Pacific has been a very, very good thing. And I know it's a troubling moment at the moment, but it strikes me as unlikely that in the future we will only want to invest in companies that sell within their own market. So on that basis, I think that the current moment is just something we're going to have to grin and bear.
Yeah, absolutely. Yeah, lots of these companies have very long histories through macro events, and they'll no doubt go through many more in their history, I guess, as well. going to want to whiz through the portfolio a little bit. Another area I wanted to talk about was the AI related area, another kind of huge area that's kind of driven markets over the last little while now, really. And that trend in the kind of hyperscalers kind of increasing AI related capital expenditure at really quite high rates seems to have kind of continued, certainly for the time being. And the fund is clearly exposed to several of the kind of major players in that space, but also avoiding some of the others. So I wondered if I could ask you to talk through how you're assessing the opportunities and the risks in that space at the minute.
Yeah, I'll just start by my best one-liner in the world of AI. Actually, it's not even a one-liner; it's a one word in AI at the moment. Is we were having a conversation with the CFO of Marriott, who I think is definitely one of our sort of best CFOs. And we said to her, this is a direct quote. I said to her, what's Marriott doing about AI at the moment? She said, nothing. And we say, how so? And she said, well, if you're in hospitality, if you have to make sure that what you're offering, say AI-enabled booking or reservation or check-in, works 100%, because if you brand people off, then unfortunately you may not get another chance. So that was, I think, a good illustration of how a high-quality business was very much in wait-and-see mode. I mean, of the names that the question is alluding to, so to remind people, we do own Microsoft, we do own Meta, we do own Alphabet, we do not own Amazon, and we don't own NVIDIA or any of the other chip players. I mean, the company I have most confidence in, or I think is in the best position, is Meta, because the capex that it is spending on AI is actually for consumption and use by its own applications, and thus firsthand it gets a kind of immediate feedback on whether this spending is actually worth it. And secondly, if it decides that it's not worth it, then it has the power or the ability to stop it extremely quickly. And in fact, you may recall that after the after the company was renamed Meta, there was a lot of spending on the metaverse, which I still think will be a big thing in the future. But after the market decided that all this spending on the metaverse wasn't a very good thing, Mark Zuckerberg, as the saying goes these days, pivoted very quickly. You might say, well, can't Google, Alphabet, Microsoft, and Amazon also change tack very quickly if they decide it's not worth it? And the answer is, well, it's more difficult for them because they are basically supplying a product or a service to other people, and it's quite difficult for one of them to stop if the other two keep going. So it is certainly the case that in the past, even with very, very big increases in expenditure on a lot of stuff, lately AI, that these companies like Microsoft have still been able to grow free cash flow pretty significantly, whereas it is the case that this year that's probably not going to be the case. So that's definitely something that we are thinking about.
Yeah, no, thank you for that. That's useful summary. You very kindly give us update meetings very regularly, and one of the kind of takeaways we often get from that is you presenting pretty insightful trends and data on that you're picking up from corporate reporting, and kind of it's clear that that's something you monitor obviously very closely. I wonder if there are any other trends that you're currently picking up, perhaps in relation to the consumer, maybe, or some other area that you're kind of feeding through into your analysis at the minute.
Yeah, so I always remind people. Sometimes people refer to me as the head of research, and I always remind people that at Fundsmith we started with 8 people, so everybody's called head of something. But the MO of the firm is very much that everybody keeps as much focused on the day job as they possibly can. And one reason, so 99.99% of the time, I'm just a regular line analyst. And at least that enables me to pick up on some of these things. I mean, one thing which is certainly the case with the consumer at the moment is evidenced by 2 companies, one of which we own, and one of which isn't even in our investable universe, but I think it's quite interesting. So the company that we own, where it's evident, is Marriott. So Marriott owns 30 brands, but they're roughly divided into the uber luxury ones like Ritz-Carlton, JW Marriott, the kind of what are still called upscale brands like Marriott brand itself, Sheraton, and then the lesser brands, the ones that don't offer full service like Courtyard, Residence Inn. And it's in and there's a metric in hotel land called RevPAR, revenue per available room. But basically, that's just a fancy way of saying what a room price is done and what's occupancy be like. And if you look at Marriott in their luxury brands like Ritz-Carlton, they've been able to put prices up, and they're still getting more guests. In their mid-market brands like Marriott, they're also able to put prices up, and they're still getting more guests. And in their cheapest brands, they're actually had to put prices down, and they're getting less guests. And then a company I came across the other day, which is so the largest kind of sit-down dining company in the world is actually, the name won't be very familiar to people over here, but its brands are. So the company's called Darden Restaurants, but their big brand is the Olive Garden. And a lot of people are very rude about Olive Garden, but actually the food's really good and it's tremendously good value. And there's a metric in dining called like-for-like sales, which kind of excludes the new restaurants. And in their most recent quarter, Olive Garden's sales were up 7%. And that contrasts, for example, with McDonald's, where in their most recent results, US sales were down nearly 4%. I mean, that's a big difference between sort of the biggest fast food company and the biggest what's called casual dining company. And one thing that these companies can do a lot better now is with all the loyalty card type stuff, and they have a lot more information on the customers. And Olive Garden said, when asked why they were doing so well, said they were doing particularly well with people who earned over $150,000 a year, which is in the US, I guess being a wealthier country is still a big cohort. Whereas they were doing significantly less well, actually doing poorly with people earning under 50,000. So the message is very much that. I mean, it's kind of fairly evident for the fact that we've got pretty full employment, real wages are going up. Those who are making money are still spending fine, but at the lower end of the scale, the consumer is certainly very, very hard pressed.
Yeah, no, thank you for that. Fascinating to kind of delve into the read across for different segments of the consumer market and consumer behavior, I guess, as well, with some of that data. And yeah, thank you for that. So both yourself and Terry often talk about the substitutes bench for Fundsmith, and clearly the portfolio is reasonably concentrated. You kind of keep that list that gets in the portfolio relatively tight, but you obviously have this kind of list that is competing for capital for those that those companies are in the portfolio. I wondered if you're able to share kind of any insights into areas, sectors, or categories of where you are kind of focusing the research effort at the moment. And I wondered, the reason why I asked that is whether that might give us any insight into kind of trends for recent activity or where you see the kind of portfolio evolving.
The biggest area of change there is actually the opportunity set getting lower, unfortunately. I mean, we talk about our investor universe being sort of 90-something names, which is up from, I think, 50-something when we started in 2010. And that's great. It would be even better if it was a lot more than that, because we would have a lot more choice. Some listeners may recall, or may be kind enough to recall, that when we started, we owned a lot of the big consumer names. And not only do we not own nearly as many of those anymore, but a lot of them have become, I think, unfortunately, significantly lesser businesses. I was looking at a number the other day, just for the purposes of this meeting. But if you take Coca-Cola over the last 50 years, roughly, so Bloomberg, my source for this, doing something sort of quick analysis, is goes back to 1974. And between 1974 and 1998, shares, or your total return in Coca-Cola, was over 24% a year. I think your total return was thus 17,200%. So that's sort of 24 years, 74 to 98. Between 1998 and today, your return has been compounded at 4.5%. that's a big change. And as we know, or that there are those types of big secular changes, and our job is to work out whether these are cyclical or secular. But it is the case that it looks to us, I mean, also areas like alcoholic drinks, looks to us that there are some secular changes at play that make the kind of the true investable universe not quite as big as it used to be, or certainly consumer is not as fertile a hunting ground as it was, for decades. At the same time, we always at the start of every year say we have to be more diligent and active about writing up new opportunities. And we now have a slightly bigger team than we used to. And so we have opportunities to do that. And so we are spending more time writing up names that a lot of them are US, but they're kind of like, you might not think of them as sort of typical Fundsmith companies because they're not consumer or they're not sort of tech. So, I just wrote up a company called TJX, which owns the TJ Maxx, Marshalls, home goods brands in the US, and owns TK Maxx and various other things over here, which is an extraordinary business for reasons maybe we can go into another time. A colleague of mine has just written up Wolters Kluwer, which is the company over here that basically supplies kind of must-know information to professionals, doctors, accountants, lawyers. So we recently wrote up a company called W.W. Granger, which again is kind of not very well known. It's a US company. It's kind of, if you think of what goes into making a factory work, so things like gloves for the assembly line employees, the bench that people sit on when they take their lunch break, it supplies all that sort of stuff. It's known as the company that keeps America working. We've never been very never been very big in logistics because it tends to be rather capital intensive, but we found this company called Old Dominion Freight. So we're trying to look at some of these things which are a little bit more off the beaten path. Now, in some cases, we decided we were right not to have looked at these companies all a lot. I mean, for example, we have our annual general meeting, and every year someone, generally of an elderly type, comes up to us and says, the world's not getting any safer. Why don't you own defense stock? So we did a big piece on the defense sector and decided actually, it had issues or risks in terms of, it's generally, got one customer, your government. So I guess the summary is we are trying to explore more things than we did in the past, but unfortunately, in keeping to the sort of the guardrails that we said in the past, we don't find probably as much as we would like.
Yeah, interesting. Yeah, I think it is perhaps an unappreciated thing about the Fundsmith portfolio that it has, although turnovers remain very low, but by design, by very much kind of that's what you want. But it has evolved over the years, like the consumer.
Yeah, we were, I was always, when we started, if somebody had accused us of being a stamp collector of consumer necks, it would have been hard to push back. But I think. I think we actually correctly foresaw a lot of things. For example, Colgate started off with Colgate and then went to Colgate White, Colgate Optic White, Colgate Optiv White, Platinum. Becomes a point when, one of the things I said to Terry is kind of, how many people actually say my toothpaste works better than, so, things like that. Babies used to be a fantastic market in terms of nappies and diapers for Kimberly-Clark and Procter & Gamble. When China had a one-child policy, they all wanted to buy the best. They all, again, that's not as, with the falling birth rate, that's not nearly as good business. So things change.
Yeah, no, thank you for that. I said I'd come back to looking at kind of ownership structure and the management. You've already in at least a couple of questions kind of referred to kind of quality of management or the kind of leadership profile. And that's clearly something that you really have a very sharp focus on. I wondered if you could kind of give us some thoughts in relation to that, especially because it has been a reasonably busy period of kind of manager change, both in and out of the portfolio. Could you kind of give us some thoughts on kind of how you view leadership?
Yeah. So, Charlie Munger said that any year you didn't trash one of your sacred cows was a wasted year, and Warren Buffett said that you should always own you should always own a company that can be run by an idiot, because sooner or later they all are. And I think it's time to invoke what Charlie said and trash that idea of being able to own companies that could be run by an idiot. Because I think in today's world, that is a lot more dangerous than it used to be. I mean, you could say, now, I don't want to use the word idiot, but you could say that, for example, Satya Nadella's predecessor at Microsoft was not the best chief executive, and thank heavens that Satya Nadella came along. But he's, self-evidently his predecessor, even though he was not well liked by the market, didn't destroy Microsoft. But I think when we see poor management, we are much more inclined to run than we used to be. And to your point, I mean, so we have recently had management changes at Coloplast, which is one of our Danish companies. We've also had a chief executive change at Novo Nordisk. We have got a fairly recent new chief executive at ADP, which was run by one of our absolute sort of favorite chief executives, Carlos Rodriguez. And so, that seems to be going okay so far. We clearly had the change that I mentioned at Unilever recently, which we think is a good thing. But certainly, I mean, when we do kind of post-mortems on things that went wrong, I think one of the things we find almost all the time is that we had our doubts about the person who came in to run the business, and we didn't act quickly enough. I mean, I think we had our doubts about the guy who ran PayPal quite early on. We had our doubts about the guy who ran Estee Lauder, actually the team that ran Estee Lauder quite early on. We had our doubts about the guy who ran Nike. We still own Nike. But it's, I think, I mean, to say the world has become more fast moving, it's probably a slightly sort of vacuous comment, but I think it's probably true. And I think if you miss steps, particularly in technology or areas like we mentioned, like payments, it's pretty difficult to come back.
Yeah, absolutely. Yeah, thank you for that. You mentioned that there's a question that always comes up in the AGM kind of every year. Another one I think always comes up in the AGM is kind of that highest conviction idea. And it's one that we actually ask all of our speakers as well. I hope it's not the kind of toughest question, but it just kind of gets an idea of kind of where you're really kind of got a kind of optimism at the current time. If there was kind of one area of the portfolio that you'd look to kind of being high conviction, where would that be?
Well, so I always give the same answer to this, which is that if your highest conviction is not in one of your recent worst performers, then you shouldn't be still owning that company. And so on that basis, I've got to say Novo Nordisk. I mean, Novo Nordisk has been deeply frustrating to us. It was obviously the first to market in terms of weight loss drugs. It has, I mean, first of all, it's had production problems. It has allowed itself, because of the production problems, it has allowed these people called the compounders to get into the US market and take about a third of the market. And these guys are, I mean, in one sense, they're absolutely brilliant. I mean, they're still, even though they've now been told to stop producing, they produce a slightly personalized version of your Ozempic or your Eli Lilly Mounjaro, and then they say, oh, well, not breaching the patent because it's a sort of slightly different version. So, I mean, they're very crafty marketers. But in the meanwhile, I mean, the big thing at the moment, and not to go on for too long about this, but I mean, one of the big things is that Novo has allowed themselves to, or has allowed the narrative to become that the first to market with an oral weight loss pill will be this drug called orforglipron, manufactured by Eli Lilly. Novo Nordisk actually has got an oral version of semaglutide, which has been on the market since 2021. And one of our parting conversations with the chief executive was, the narrative is Eli Lilly is way ahead in oral pills and in oral weight loss pills, and sort of what's happening. And the response was, well, we've screwed up a few kind of launches or results tests, and we don't want to do it again. But so it's been there are some stocks. I mean, Facebook, now Meta, was the kind of original, I think, hard stock for us to own. But I've got a lot of conviction that in the end, the numbers in terms of Novo Nordisk and probably Eli Lilly as well will actually out.
Yeah, no, thank you for that. I'm glad we got a snippet on the weight loss industry and a kind of fascinating market as well. Yeah, thank you for that. Julian, thanks so much for spending some time for this. Really appreciate it.
Thank you so much.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.